Hello everybody, welcome to Confident Compounding with Corey Kramer. Today I'm going to be going through a list of a dozen stocks that I've had requests for that I probably won't be buying, and I'll do a quick run through. Occasionally I do this, especially when my list starts getting really long over there. If you have a request, put it down in the comments. I'll get the ticker on the chalkboard behind me. Eventually I'll make a video. If it's something that I might buy in the future, or that I think there's some sort of, investing insight into it that I can give, I'll make a long form video about once a month or so, maybe once every couple months. I go through and I scan through the list and kind of take a look at the ones that I can give kind of a quicker response on, usually because there's not enough information, or they don't fit my strategies very well, or I know that I'm probably not going to buy it. Sometimes I just do that in the comments when people directly ask me about them. If I know right away that they're going to fall into that category, but sometimes I don't. I put the tickers up there and then I look at them later. And so that's what this video is going to be about. People seem to like it the last time I did it. And we're going to run through a dozen requests that I probably won't be buying for a variety of different reasons. Okay, first one is Wix. If I recall, these guys do like website domains and design. WIX is the ticker. So the issue with Wix is there isn't really anything wrong with it that I can tell, other than we only have data going back to, well, actually let's max this out to 2014, which seems like a long time, but the only real recession we had was in 2021, and during that time earnings went negative. So that implies that they could be more cyclical than previously thought necessarily, or they just could be more cyclical in a downturn. What that means is these earnings, just like they did here, could fall off very quickly, maybe even go negative in a recession. And that kind of makes sense if fewer people are, starting businesses or putting money into their websites and things like that. Just slower economic activity overall. And for deeply cyclical businesses, or even somewhat cyclical businesses, I really want long-term data to see how they did during these previous down cycles, how they came out of it. Now this one, it looks like they bounced back pretty good, but we did have a bunch of government stimulus and things like that. So it's a little difficult to know on an earnings basis kind of what future earnings are going to look like if they go up and down a lot. Now I actually do track this one, and I was tracking it as a fast growth business. Now they're pretty decent size already, $8 billion market cap, almost $9 billion. And the issue that I have is they aren't really growing fast enough for a fast growth business kind of this size for me. So the PE is only 23. I'm not sure what the basic earnings look like. Yeah, so they look a little lower, more like 56. So that's probably really what we're looking at. When I checked the revenue growth, I want to say it was like 50% over 3 years. That's not really fast enough to get me interested in a growth business trading at that kind of ratio. So I don't think they have a lot of big growth in front of them enough to justify kind of where they're trading at now, especially when we consider those earnings could go up and down quite a bit rather than just have like a secular growth going forward. So my main issue is they just aren't growing fast enough for the type of business that they are. Now, if it was a long-standing, stalwart type business where earnings were very predictable, then that's a different story. But they're not really that type of a business. So that's why I still track it in case things change in the future, but that's why I don't have a buy price on it right now. Next one is Boot Barn, ticker BOOT. This is one where, again, we don't have a ton of information. We have about 10 years of history here. It's in retail, apparel retail, which is always really hard. Usually it's mostly only shoe companies that I'm buying in this, but not every now and then I'll take a chance on one. But you can see that their earnings are, again, really unpredictable. So this huge surge during the COVID stimulus boom, now we're kind of having the bust. It looks like maybe they are starting to recover from that, but it's so hard to know what these future earnings are going to do. We can look at basic earnings too. Yeah, not too much difference really. So when the earnings are this unpredictable, we know that this one-time growth probably isn't going to happen, but maybe these declines are part of that. And analysts think earnings are going to grow 6% this year at a 27 PE. That's not really attractive. So just kind of goes in the too hard category for me. And then I know the industry is difficult anyway. So the threshold is a lot higher for me to invest in something like this. I usually would want it to be really small. So you have like a 20-year growth trajectory, or just more than one brand. We bought like Deckers, right? Multiple brands, history of executing well, like that type of thing. I might make an exception, but usually I'm just going to kind of lay off these type of stocks. Technoglass. I had not heard of this one. I looked up it, and according to my very brief research, it looked like they're based out of Colombia, but they do most of their business in the U.S. Chart is pretty interesting. I looked at their home building products, like I think it's like architectural glass and things like that. It should be a cyclical industry, and we do see some signs of that back here, pre-pandemic. And then we have the huge boom here. The earnings fell last year. So it's just a little too unpredictable for me. And it's in an industry that's usually pretty cyclical. So these earnings could be unreliable. So I would just put this one in the too hard category for now until they go through like a real recession and then come out of it, and we can get some idea of how that would like affect their business. They're small enough where maybe their growth will be big enough to overpower it, but it's hard to say. So Ozark Bank, this one's pretty interesting. I bought this one in 2020, March 2020. I think we had a double out of it, and I sold it pretty quickly. Now the reason I sold, I didn't put the date up there, is, and I sold this one a little sooner than most of my banks. If I remember correctly, they had a lot of like commercial real estate exposure, and it seemed like there was worry there from investors. Now the stock really hasn't done much since I sold it. It's just kind of been hanging out here. Now I'm sure it looks attractive because that low PE, but the issue is we don't know what kind of risk they're taking. So whenever I have a bank these guys have a long history, but I think they've kind of changed what they did, during the great financial crisis to now. And there's just a lot of worry about how much risk they have with their loans and stuff. I don't know how to quantify that. So to me, I sold and took my 100% profits or whatever, and just went with more kind of established, bigger name regional banks if I was going to buy them. Most of these regional banks trade similarly. So you want to get the ones that are the higher quality and the lower risk. So whenever there's any rumors that there could be higher risk, then I just kind of lay off of it. I don't feel like I want to take that risk because it's very hard to know what the risk is. They might not even know what the real risk is on the loans. So for me, while I don't have any solid evidence that there's extra risk, I think it's hard to quantify. So I'm just going to be avoiding that one for me. Brunswick, okay, so ticker BC, deep cyclical during the Great Recession. These guys I always think of bowling alleys and stuff, right? But I think they have other products like that. But definitely leisure, and you can see that we had the boom when everybody had extra money, and now we have the bust when nobody has as much extra money. Now, it's not as bad earnings-wise as it was back here where they had 1, 2, 3 years in a row of negative earnings, losing money. But what that lets us know is if we do have a recession, it could get worse. So even though the stock is down a lot, it could get worse. This is one I would want to buy coming out of a recession, where maybe you have some cash left over and you can capture this kind of move, you get your 15% CAGR, but not try to catch the falling knife on one like this. This is coming out of a recession type of business, not a buy on the way down type of one. Let's see, Silgan, I think is what this one is. Silgan Holdings, another one that I previously owned. I forget. I think we made a little bit of money on this one. So what eventually had me sell, which was in July 2023, so it's still up a little bit since then, is I started, because interest rates basically started rising for the first time in terms of a steady rise in 40 years. I didn't used to pay much attention to debt because it was so cheap. I didn't think it would really affect most of the stocks, and I had a mean reversion formula that I would use. In mid 2023, I got rid of them. I stopped using mean reversion because I wasn't sure how much mean reversion we would actually get with interest rates going in the opposite direction as they were before. So valuations could be lowered, just generally speaking, because interest rates are higher. So companies that had extra debt, I basically sold, and this one fell into that category. So you can see the total enterprise value is, not quite double the market cap, but maybe like 80% more than the market cap. So that was enough for me to just go ahead and take profits in it, and try to find businesses that had less debt. But really what happened was I would take the debt into the account of the valuation. So if you look at the PE, I just said the PE is like 14. But the debt I said was approximately like 80% higher. Well, if you add 80% to 14, I don't know what you're looking at, like 26 PE or something, 25 PE. So now it doesn't look quite so attractive. If you think, okay, this is really a 25 PE, and earnings are growing mid-single digits last year, are expected to pick up a little bit this year, but really we're looking at mid-single digit average earnings growth with a 25 PE. So that's pretty expensive, right? And so this one I think just looks more, I could probably make my own video on this one, but since I owned it before, I just thought I'd tell you why I wasn't buying it. Because you can buy businesses with the same valuation without the debt, without nearly as much debt risk. So the comparables on that are just, I'm going to go buy those businesses in general at the same valuation than I am going to buy this one or hold this one. Nothing against the business. And there could be a price where it's cheap enough to compel a person, but it's not there yet. Dexcom. So I was tracking this one for a while. This is another one where so the PE here is 44. They only grew earnings 8% last year, and market's expecting around 20% a year from here, maybe slightly higher. The growth for a growth stock just isn't there. It's not high enough for me. They need to grow revenues and gross profits and things like that per share faster than they're doing now to entice me to buy it as a growth stock. So it's it's trading at a 44 PE. I mean, I think it probably needs to trade at a PE like half that to be interesting. So it's just not anywhere close to like where I would want to see it. And the reason the stock is probably compressing here is probably because the trend on the growth is probably slowing from where it was, back, say, in 2020, 2019, when it was kind of rocketing higher. So I don't have like a big picture view on this one, but for a growth stock, I want faster growth is the short story. ERJ. Oh, Embraer. So airline maker, right? Yeah. So, well, with all the problems with Boeing, I mean, you can see why let's widen this. So here's the issue. I think the people who bought it around here have done well, and that's good for them. It's really hard to, you can see that, and this is going to be in US dollars. That probably plays a role because I think they're out of Brazil. Yeah. But the overall trend here is worse earnings growth or earnings declines and then losing money. And now we have what looks like a potential legitimate turnaround. It's just really hard to predict these turnarounds, and so I just think it's going to be too hard to predict what this one does in the future. But I will say congratulations to the folks that did buy it down at the bottom. That's just not 9 out of 10 times that strategy doesn't work. I think there's a couple stocks that it's worked with lately. In the airlines, Embraer looks to be one of them. Rolls-Royce is another one that had a similar kind of thing happen. Very hard to predict unless you're an industry expert and kind of on the cutting edge of stuff. And I'm not. So like an airline, I'm talking specific industry. Universal Display Corp, ticker OLED. So this is one that just the earnings just don't seem to match up with the valuation. The price has kind of gone all over the place. It's at a 30 PE. It's only growing, we'll call it 8, 9, 10% a year right now. And it looks like maybe the internet is pushing the stock price around. I don't really understand. So I think it's probably, it says semiconductors, so maybe that has something to do with it. But it says also display. So LEDs, I think, are counted as semiconductors when they do the industry stuff. So yeah, this one seems maybe driven more by stories than actual earnings. And yeah, I don't really invest in those type. And the valuation just doesn't look compelling, right? 30 PE, maybe it's 10% growth, that's a PEG ratio of like 3, which is usually when you're looking to sell for valuation purposes. Exact Sciences. So it looks like their market expects them to start earning money eventually here. This is bigger. So long time not making any money. Biotech, that's normal for biotechs. So because I don't think I can predict whether they're going to earn money and how much in the future, it's just too hard. These just go right in the too hard category for me. I mean, if I read something that I found super compelling, which some people are just good writers, and their job is to like sell people on the future of those type of companies, I don't really want to be influenced by that. I want to be able to look at it and have my own way of understanding it, rather than relying on kind of stories basically about the future. Okay, Radnet. Yeah, I just don't. What do these guys do? Healthcare services. Yeah, so I'm not sure what's going on here, but the earnings just look too unpredictable to me. They're kind of all over the place. Again, this one might have like some kind of story attached to it because it's almost like a meme stock. Just I need to see some actual metrics like earnings, revenues, and things like that. Okay, this one just came in. So HPE, Hewlett Packard. So they broke up Hewlett Packard, and this is the Hewlett Packard Enterprise. I forget which part of it this is, but there's just not really enough earnings history. Did they put a bunch of debt in there? Not really. Probably cyclical. It looks like earnings are falling right now. Again, it's just too hard to predict what's going to happen here. And so it's just not very interesting to me. Probably when I got asked about it, it was a couple weeks ago, I'm guessing, when it sold off like this. These guys probably do the hardware because that looks like it's affected by maybe tariffs or something along those lines, I'm guessing. I could be wrong about that though. But the stock price is just kind of too unpredictable. I wouldn't the market doesn't care about this valuation. Maybe the basic earnings are the way to look at it. We have a big decline here, big up, big down, big up, now expected to go down, and the market's probably looking forward a year. So again, it's just, I would put this one in the too hard category. Usually when they divide up companies like this, it doesn't really add any value most of the time, like to the actual business. So if it wasn't a buy, I don't know, 9 years ago, it's probably not going to be a buy now unless something obviously changes. So yeah, I would just put this one in the too hard category as well. Okay, that's 12 requests that I went through that I just think are too hard, or there's some reason that, they don't fit my strategy or something. And I wanted to get through all those, and then we'll start going through one at a time on the ones that are left here. And I have weekly picks over on Patreon. If you watch this video and you think I never buy anything, every week I buy something and I try to find whatever the best thing in the market is. And then I have a full service over on Patreon and a free tier on Patreon. So Some of these requests that I get will be posted on the free tier. If you're the person that requested them, I'll let you know that I posted over there. But it's a good idea to just go join over there, and you'll get a lot more content. And you'll make sure that you get notified too. All right. Thanks for watching. I'll see everybody later.